of Kerala Infrastructure Fund Management Limited. Like the previous speaker was saying, there are a lot of ecosystem initiatives being taken by the government in order to spur funding as a catalyst in the state. So we are the equity funding platform that has been formed by a sponsorship from the government of Kerala. Right? We are a PPP model, similar to what has happened in, let's say, if you know of KIFML. KIFML is more of a debt funding platform for infrastructure. We are an equity funding platform for startups which are in technology as well as which are in infrastructure, right? So what do investors really look for? I think the previous session gave you quite a lot of insights into what an investor really looks for. I, as a professional investor, have been doing this for almost 20 years now. I have started my investor journey in 2007, kept investing into seed stage startups, tech startups, right from 2007 onwards, made around 25 investments. Managed a venture capital fund which had investors from Google, Sidby, some American foundations and all that, and returned a 30% gross IRR on these funds. So if there is an investor, there is an investment about to happen, how do you kind of enter? What do investors look for? What is the exit pattern in this? I think all of this was, in a very broad sense, explored in the previous session. But in this session, I will give you what an investor's perspective is, right? You heard this from the fundraiser's perspective, and I respect that. I have never been on the other side of the table, right? I have always been on the side of the table which meets entrepreneurs, meets founders, and says, hey, how do we figure out what is the best way to work with this founder, right? Sometimes it is funding. Sometimes it is not funding. Sometimes it is just to keep talking to the founder to ensure that the founder reaches a certain stage where you have built a relationship, you understand how the founder thinks, how the company operates, and you are able to kind of fund this company, right? So this is where we investors have to actually up our game and try to look for, when we say networking, investors are networking also with startup founders, right? We have to look for the best startups that are out there, because these are companies that are trying, whatever you are trying to do here is you are trying to change the world in a way that only you think is possible, right? You have noticed a problem, you have noticed that there is this particular envelope that I need to push, and how much do I push it by? And how do I do this? And how does the investor actually view your efforts, view your business, and where does the investor actually take this to the next stage, right? So that is what we are looking for here. I'll just get to this. So, I mean, I have been doing this for a long time. Out of all the startups that are there, only 0.05% of the startups get funded. Is that a good thing? Is that a bad thing? I don't know. What happens is, in a VC's life, if you sit on this side of the table, you're getting emails, you're getting LinkedIn messages, you're networking offline, you're receiving IMs, slide decks, etc., etc. And the VC also has a certain focus, right? There is a certain stage focus, there is a certain size focus, there is a certain mandate focus. All of these need to match with what the business plan is saying. It is not to say that that business plan is not good at this, or it is what you're building is not good enough. It is just that the fit is not there. Like, it is very similar to you trying to find a customer who wants to buy your product or a service, but you are just not the right fit for that company or for that customer, right? So what we are also trying to look for is what is that fit that happens, and in that process what happens is only 0.05%. I mean, what in my own experience I have seen is we receive roughly around 1,200 to 1,500 deals a year, and one company gets funded, right? So if you are looking at, I have an idea, this idea will take a, I'll get this funded and I'll take it to the next level. It's probably not happening at this point. From a VC, institutional VC investor, you can go to friends and family, angel networks, probably ideas may get funded, but angel networks also today are very mature and they have a very evolved decision making, right? So if I'm talking mainly about the VC investors, there are seed stage VCs. Even seed stage VCs need that seed, right? They need to look at what it is that you are building and is there enough proof of what you're building. Is there enough market validation? Any sort of framework. For example, it's a technical product. Is there an MVP? Is there a minimum viable product that they can actually see and understand that this works, right? So let's look at how startups actually get funded, right? What are the platforms that actually get funded? It's just a nice, I thought it was a nice way of saying this, is, when we look at companies, when we look at founders, we are meeting, essentially you're meeting founders, right? The company is what they are explaining to you. As when you hear what they are doing, there is a certain element of belief that you have to have in the idea that you are presenting. The belief doesn't come just from saying, being very passionate during the presentation. That is just one aspect of it. The passion is to be ground up. We should be able to see this in every aspect of your ability to present, your ability to be doing what you're doing, and seeing how it works. For example, one of the things that most VCs have is an anti-portfolio. I don't know how many of you have heard this term, anti-portfolio, which is, can you tell me what it is?
Opportunities that they did not invest in.
Right. Correct. Thank you. So VCs meet a lot of opportunities, and there are opportunities that they pass on. For example, Bessemer Venture Partners, I don't know if you've heard of them, they're one of the marquee investors in the world. They passed on FedEx 12 times, right? So I am not proud to say I passed on Flipkart twice, right? In 2007 and 8, passed on Flipkart twice, passed on InMobi. You guys have heard of InMobi. Passed on InMobi once. So these are companies you meet when they are individuals, right? And when you meet them as an individual, you are trying to evaluate what your strategy is in terms of trying to see what they're doing. So Flipkart, for example, the Bansal, the Bansal brothers as they're called, they're not brothers actually, but they're called like that, is they were selling books standing outside an Indiranagar bookstore in Bangalore, right? For us, that was immense passion. But the idea that they were saying, we will build the Amazon of India, for example, right? It takes somebody to actually believe in that idea. And if you have passed on them twice, it is me trying to say that we did not think that that was going to happen, right? We did not see that. So VCs are not always right. VCs are most of the times wrong, because 99.95% we are ignoring. Only the 0.05% we are investing. That means we are mostly wrong than we are right, right? Like, let's say what Rahul Dravid said once about whether he considers himself successful or not. He said 60% of the time, I have not scored any runs. I have made ducks or, single-digit scores. If people like Dravid, even I think Federer made a very similar statement when asked how many points he had won in his career and how many he had lost. So it's that these people are not exactly saying that they are right or wrong. The point is, there is a situation in which you make certain decisions, and in that decision, what happens? So as founders, when you put the entire company on the line for fundraising, I'm saying that because one VC said no doesn't mean anything, right? It is also, I mean, for example, Blackstone, when they first started raising the first fund, today they are the world's largest private equity fund. When they first started raising their first fund, the founder, he pitched to 532 people before he got his first yes, right? So there is an amount of funnel that you will have to kind of go through. And what happens is sometimes people believe in the story part of it. People like to believe that there is a story involved here. Who is doing it? What is your background? How relevant is it? Is there one of the things that I really like is to see an obsession in the founder about what they're building, right? And is there market traction, scalability? These things you already know. You know what this means. So I will not go into great detail about this, but you need to generate enough belief in the idea that you are professing, and then that this idea is not just in my head, it is actually on the ground. Here is the market, here is the traction, here is customer engagement, customer retention, whatever it may be. So what do we look for? We look for obsession. We need to see the founder being obsessed with this 24/7, doing just this. There are some founders who come to us saying, this is my fifth venture. So I am very impressed, generally saying, wow, you've like serial entrepreneur. No, he's doing 5 businesses at the same time, right? There is 1, 2, 3, 4, and then there is the 5th business also that is running. As an investor, I'm investing into the person, into the founder. If the founder has his or her fingers into 4 or 5 pies, it's not going to be the best buck for, the best bang for my buck. So I'm probably not going to invest into that founder. So the focus, the obsession about making one idea your life and running it is important, and trying to see that this is communicated to the investor. Like we are sitting here, we are trying to find it actually, right? And if we don't find it, then it's probably not going to work as well. Some of the most successful founders, actually I would say all of them. In fact, I have also started 3-4 businesses and failed. But there are people who have built successful businesses who have come to certain points where they thought, this is it. This month I cannot pay my employees' salaries because I don't have any cash flow, I don't have any funding. They have seen near death of their companies multiple times. And they have figured out that come what may, I'm able to survive. So if one VC says no, it's okay, I'll move on to the next one. If another says no, I'll move on to the next one. There is an element of, what should I say, resilience that an entrepreneur is supposed to be having in India, at least, for sure. In India, our balance currently, it's slowly tilting towards more funding being available and entrepreneurs being, limited in that sense. That balance is slowly changing, but it will take a while before that changes. The micro VC trend may be helping, but this is going to take time, right? Sometimes there is the ability to tell a story. We had one person who was trying to come to us with a LLM-based algorithm in 2015 or 16. And I couldn't understand what he was saying. He was using such big words, such long sentences. His entire presentation it really went over my head. I had to actually ask his team to stay back and explain it to me in a way that I could understand what he was saying. Like large language modeling, he was using large language, right? And I was like, how do I even understand what the algorithm is? How does he end up with a usable platform for the users, right? So storytelling failed on that part, but there are many people who tell wonderful stories. Sometimes you buy into the story itself, ignoring the rest of it. I think some of you know how the recent unicorns in the country have happened with just one company, and then there's another company which is just $1 billion on first round investment itself. I don't know how these things happen, but it's obviously storytelling. So if you are, as a founder, operating your company in a market that is less than $1 billion, you're probably reducing your probability of getting funded. So most of the companies that get funded, at least 60% of the companies, are operating in a market that has more than $1 billion potential, right? It's a typical VC thing. And I'm not going to stay away from cliches in this presentation. I am a VC, I am entitled to my cliches. So I will have $1 billion market opportunities. Otherwise, there is no space for people to come in, copy your idea, have multiple players, then prove that you are the best player in this. This is how usually the market operates. And you will need to weather that storm. Right? So you may be creating that market, you may be creating that particular category in that market, but you will have to be the leader in that market, either by execution or by inorganic expansion. Some of late, what we have seen is funding itself becomes a competitive advantage. Where you have more funding, you acquire all the smaller companies in your sector, in your category, and suddenly you are the category leader. That is something that works. Traction. So many times we meet founders who have come to us with business plans. I have funded a company which was a mere business plan on paper, and they went on to become a $1 billion company in over, I think they're today a $1 billion company. But when they came to us, they were a business plan on paper, having a failed company as their past. They had proof of momentum in their current company, which they said, the same solution that we have failed with in the previous company, we are bringing it to this company, and we are making these tweaks and ensuring that the same customers move over here. So sometimes, even if you have a failed startup earlier, it still works in your favor if you are able to build upon that either technical expertise or that market knowledge that you have gained from that. And most importantly, what you would have gained, what I have seen mostly that holds these companies through, is the team that sees through these things, right? There is a team that has stuck with you, and you are able to go through one failure and then move to the next one, where now you are able to see light at the end of the tunnel, that this one is going to make it, right? And I hope that you don't have a failure, but then if that is the part of the process, if you are looking at it, then that is something that could be happening. Scalability, if there is no scalability, then please don't go to an investor. Don't waste your time. Forget the investor's time. They may have a lot of time to waste, but your time is, if you're not building a scalable business, then you rather go to the customer. Don't go to the investor, right? So just ensure that you are able to follow what your business is building. I think the previous speaker mentioned about lifestyle businesses and fundable businesses. If you're building a lifestyle business, there is absolutely no problem with that. In fact, in India, 95 to 98% of the businesses are lifestyle businesses. And there is nothing wrong with building a lifestyle business. I am a VC, I'm looking for investable, fundable businesses, right? So I manage two funds. One is the Kerala Innovation Fund. One is the Kerala Infrastructure Growth Fund. So on the Innovation Fund, we have a 250 crore corpus. We are looking at early stage companies, seed to Series A, and we are kind of looking at little bit of traction on any front, funding, revenue, customers, whatever it may be, right? I have put a few sectors here, but essentially we are sector agnostic within technology, looking at anything that could be pushing the leverage on technology and looking at, like I said, billion-dollar market, scalability, traction, and how well you're able to do this. In infrastructure, what we are looking at is this is a sustainable infrastructure fund. It could be in the areas of clean energy, anything that is to do with, let's say, EVs or anything to do with infrastructure building. We are trying to look for companies that are doing anything in this area, right? This fund per se is, like I said in the beginning, and I'm just trying to reiterate this, this is a Kerala state government sponsored fund, which we are raising funds from other private equity partners, other private individuals, building on top of what the government has sponsored and helped us do, in order to help invigorate. There are very few, or maybe as far as I know, no institutional investor in Kerala for the seed stage or the early Series A stage. You may have investors in other parts of the country who are investing in Kerala-based startups because of what incredible work that the Kerala Startup Mission does. But what we are looking at is trying to grow the VC ecosystem in the country, in the state, to kind of build this for the startups in Kerala. Because I have been in Bangalore all my life, I have been in Chennai, I have been in Hyderabad, Delhi also. Most of them building there. There's at least one founder in the founding team who's from Kerala, right? If not the entire team. So if we offer enough encouragement, if we offer enough platform ability in Kerala, I think we can have people come back here and build those businesses sitting in this beautiful state of Kerala, right? So this is my email ID. If you are looking at funding opportunities, if you want to kind of reach out to me, it is this. You can reach out to me straight away, write me an email, tell me that you sat through 25 minutes of torture at this session in this event, and we could probably have a conversation. And if you have any questions, I'm happy to take them now. Thank you. We are a very new institution. We have started in the last year, actually, 2023, November, we started. So we are about to make our first investment, in fact, this month. So I hope that's a success story, but I'll be able to reveal more details later. But we are ready and open to finding our first batch of investments. Yes, please. That's a very good question. Mostly what happens is, his question, I don't know if everybody heard it. His question is, does the shareholding or the equity holding of the founder in the company really matter? If the founder has 50%, 60%, or if the founder has lesser, it could be either ways, does it matter? As a VC, we always look for founders holding majority stake, right? It should be at least more than 50%. The founding team should hold more than 50% at any given point of time. At least till Series A, Series B, it should be the case. The reason being, we are investing on the founder/founding team in the early stages. So there is no logic for the investor to hold, let's say, 70% in that company and founder holding 30%. And if the company is, let's say, 100 million worth, then the investor is getting $70 million. I'm just numbers off the cuff, okay, back of envelope. The entrepreneur is not incentivized to build this business. He's only making 30 million. So for he or she is making only 30 million. Why would they put in that much effort? They have to put in effort for the entire 100 million to earn 30 million, whereas the investor is just bringing in funds, which is fair enough, but then that is not something that the investor wants. The investor wants the founder to know that they will also win if the investor wins. And that is how investors actually operate in a company, right? So founders should be holding majority stake, founder/founding team. If your question is within the founding team, one founder is holding a lot of equity, the other founders are holding lesser equity, is that okay? That will be dependent on what is called a founders agreement. Between the founders, there should be an agreement that is signed where you have envisaged what is going to happen in this scenario. Sometimes the founding team is very clear. They know that this person is the leader of this company and they'll give this founder maximum stake and they are okay with that. And the other co-founders are like, okay, we are operating around this. So there is a clear leader and that is okay. In some cases, they are having 33% each. That is also okay, as long as the operational responsibility is fixed on one person. There should be a CEO, very clear CEO should be there. So that is something that investors look for. So responsibility should be very clearly fixed. Yes, please. So when you say number of founders, are you saying if too many founders are there, is that a problem? So I have seen a company that had 7 or 8 founders, I think. They were all together in their engineering days. I think I saw that majority of the room is engineers. I'm also an engineer. End up doing random stuff later on. But, they were all together in engineering. They passed out together. And they had good chemistry going on between them. And they were happy that they were the founding team. And they were okay with that. And they had very clearly demarcated responsibilities. So as long as we are able to see that, it's okay. If 20 founders are there, then I don't know. Like, I don't know if you know of this case, Jabong.com. This was one of the e-commerce companies that came up in, I think, 2011-12 types. Rocket Internet funded them, and they had around 15 co-founders. Rocket Internet held 80%. Co-founders held 20%. So each one held 1.5%, 1 point some percent. They were not interested in building the company. So some of the founders kind of just checked out. Some of the founders did some other things, which is probably a conversation over dinner or a beer or something. But for now, that is when there are founders, ideal number of founders is how much the company needs. Right now, if you're starting with this, then you probably have one CEO, and then there are, let's say, 2-3 people managing, let's say, sales, operations, and finance. Finance also, the CEO can co-manage. So generally looking at a 3 to 4 member founding team seems to be what I have most usually come across. It doesn't mean that you should optimize your founding team to be 3 to 4 members. Whatever works for your company, works for your company, right? Yes, please. So, is there a minimum revenue threshold that we are looking for in order to fund startups? So there is no minimum revenue we are looking at, but we want to be convinced of the fact that this product fits into this market and there is enough customers who are able to kind of buy into this product. So there's that product market fit that we want to be sure of. So I don't have a number off the cuff, but if there is a number of, let's say, 3 crores, I think that would be comfortable. I don't know. But when you come, like there are some defense tech startups. They are 0 today, but they have signed a 950 crore contract with somebody, a defense agency. Now that company will go from 0 to 950 in 3 years, but they are never going to meet my 3 crore number. they suddenly be at that number. So how do we actually evaluate this and how do we take it forward? So it depends on multiple things, but generally this is how we look at it. Okay, I thank you for this. Thank you for hearing.